Hi everyone, in this lesson, we're going to understand cash versus accrual accounting, what timing differences mean, and how items like prepayments, unearned income, accrued expenses, and accrued income affect the income statement, profit and loss, and the balance sheet. First, cash basis. A cash transaction is recorded only when money is actually received or paid. So on cash basis, no cash movement equals no accounting entry in profit and loss. Example, cash received from a customer. Bright Services Limited does a job on 20th March and the customer pays on 5th April £1,000. Cash basis rule, record income on 5th April when cash comes in, not March. Cash basis entry on 5th April, debit bank £1,000. Credit sales, income £1,000. Even though the work happened in March, cash basis shows the income in April because that's when cash arrived. Now, accrual basis. An accrual transaction is recorded when it is earned or incurred, even if cash hasn't moved yet. So, accrual accounting matches income and expenses to the period they relate to. Example 1. Credit sale. Income earned, cash later. Same scenario. Job done 20th March, customer pays 5th April, amount £1,000. Accrual basis entry on 20th March when earned. Debit trade receivables, debtors, £1,000. Credit sales, income, £1,000. When customer pays on 5th April, debit bank £1,000, credit trade receivables £1,000. In March, we recognize the income because we earned it and we show a debtor on the balance sheet until they pay. Example 2. Expense incurred, bill later, accrued expense. Electricity used in March, £300, bill arrives and is paid in April. Accrual entry at 31st March, debit electricity expense £300, credit accrued expenses, accruals £300. When paid in April, debit accrued expenses £300, credit bank £300. We show the March cost in March profit and the unpaid amount sits as a liability until paid. Here are the key differences. When income is recognized, cash. When money is received, accrual. When income is earned, invoice, work completed. When expenses are recognized, cash. When money is paid, accrual. When expense is incurred, used, consumed. Balance sheet impact, cash. Fewer timing balances, debtors, creditors often missing. Accrual shows receivables, payables, accruals, prepayments, deferred income. Quality of reporting, cash, simpler but can mislead month-to-month performance. Accrual, more accurate measure of performance for a period. Timing difference means the cash date and the accounting date are different. Income recognition, accrual basis. Recognize income when you have delivered the service or supplied goods and you have the right to be paid, often invoice issued or work completed. Example, service delivered 28th March, invoice 30th March, paid 15th April. Recognize income in March. Expense recognition, accrual basis. Recognize expense when the business has received the benefit, used goods, services, even if not paid yet. Example, March rent relates to March, even if paid in April. Expense belongs to March. On 1st March, Bright Services Limited pays £1,200 for 12 months insurance. Accrual logic. Only the portion that relates to this month is an expense. Monthly insurance expense, like £1,200 divided 12 equals £100. Entries on payment, 1st March, debit prepaid insurance asset £1,200, credit bank £1,200. At month end, 31st March, recognizing March cost, debit insurance expense £100, credit prepaid insurance £100. Impact, income statement, March, shows £100 expense, not £1,200. Balance sheet, 31st March, prepaid insurance asset equals £1,100. Prepayments increase assets and prevent profit being understated in the month you paid. On 15th March, a customer pays £600 upfront for 3 months support. That money is received, but as at March end, the service is not yet delivered. Entries on receipt, 15 March. Debit bank £600. Credit unearned income. Deferred income, liability, £600. When April service is delivered, 30th April, debit deferred income, £200. Credit sales, income, £200, £600. Divided 3 months, about £200 per month. Impact, income statement, March, no income yet if nothing delivered. Balance sheet, 31st March, liability, and £600. Script line, unearned income is a liability because you owe the service. Accrued expenses, expense incurred but not paid yet. March wages earned by staff but paid in April. Wages for last week of March was £800. Paid on 5th April, entries at 31st March. Debit wages expense £800. Credit accrued expenses liability £800. When paid 5th April debit accrued expenses £800. Credit bank £800. Impact income statement March, cost includes £800. Balance sheet 31st March shows a liability £800. Accrued expenses ensure profit isn't overstated by missing costs. Bright Services Limited completes work by 31st March worth £1,500, but invoice is sent in April. Entries at 31st March. Debit accrued income, asset £1,500. Credit sales, income £1,500. When invoice raised, customer pays later. Replace accrued income into receivable, then bank on payment. Your system may do either approach. Debit bank £1,500. Credit accrued income £1,500. Impact income statement March shows £1,500 income. Balance sheet 31st March shows asset £1,500. Accrued income increases assets and prevents profit being understated. Quick summary, wrap up. To summarize, prepaid expenses equals paid early, asset now, expense later. Unearned income equals received early, liability now, income later. Accrued expenses equals used but not paid, liability now. Accrued income equals earned but not received, asset now. Accrual accounting gives a clearer monthly profit and a balance sheet that shows what's owed to you and what you owe others.